Welcome to another Financial Planning Solutions. It's the summer edition for 2017, Linda, and it's been
Yes.
a wet summer so far, a couple of good days, but
Yeah.
a lot of rain. We haven't had to water that much.
Yeah, that's the benefit part, right?
Some of you have received or will receive shortly our summer edition of our newsletter, in which we mentioned that on Fridays the office is closed, but
Right.
you can still call us.
Yes,
Yeah.
we will we'll be monitoring the phones and emails so that if something is urgent, you will still be looked after 100%.
Before we get in talking about interest rate changes and other financial matters, we want to mention that we have our barbecue coming up,
Yes,
and that will be on the 16th of August.
yes, the 16th of August.
So we want you to be there for all our usual barbecue goodies right at the office. Now, just a couple of days ago, as we're recording right now, the interest rates have gone up, first time in 7 years. What does that mean?
Well, they finally feel that the economy's in a position that the interest rates aren't going to devastate everyone. And so it's gone up 1/4% now. The important thing for all of you is to make sure that you're paying down your debt as much as possible. Now's the time to look at locking in those low rates if that happens to be an option for you. And if not, then look at increasing the frequency of your payments or increasing the amount of the payments. You definitely want to put as much as you can down while things are low now. Because we're looking at things likely going up a bit more. There's a fairly strong reason to believe that they'll increase it again this year, and then possibly again in the new year. So you want to be paying down your debt as much as possible. It's guaranteed. You're getting guaranteed rate of return with no tax implications.
But how about savings, though? I mean, is that 1/4% going to make too much difference in your savings?
Well, for those people that are purchasing GICs, yes, the 1/4%, is still nice to see. With regard to your other savings, I don't think it will have any impact one way or another. It's still not the best growth option. People that are looking at GICs are looking at guaranteed because they need the security. It's something that's shorter term, in the next 1 to 2 years that they're going to be using it. Still more value from a growth position if you're looking at long term to use investments that are not linked to interest.
Always give us a call, of course, if you have any concerns. Now, something we've recommended over the past number of years since they became available, and that's the tax-free savings accounts known as TFSAs.
Yes.
And but there's some concern just recently about people who may be a little too aggressive with their TFSAs. Can you explain that?
That's true. CRA has come to their attention that some people that are holding stocks in their TFSAs are trading them aggressively, frequently, and making major money on those stocks. And
What's wrong with that?
nothing wrong with that, but the structure of the TFSAs are that when you're selling something, you're not having to pay any tax. And what they're looking at is if it's a lot of trades and there's a lot of money working there and you're getting significant gains, they have actually said, no, this is considered a business, which they've done in non-registered as well. If somebody is a day trader and that's like a big part of their life and they're making a fair bit of money on that, they will look at that and say that's business income, and then you don't get the 50% reduction on capital gains. They're doing the same thing in a TFSA. So if they're seeing extreme trading, I'm cautioning anyone who would be considering doing that be prepared. CRA's on the hunt, and they are then saying, okay, there's no tax break anymore because this is a business and you're just hiding it inside of a TFSA.
So now let's look at the markets now. The markets have been going up and up and up over the past little while. Now we know that which goes up eventually must come down. That's what's happened in markets since the beginning of time, practically. So really, what should we be looking? Should we be greedy? Should we be fearful? What is your take on all of this?
Well, I mean, the markets were going up significantly in the last number of months, weeks. We're seeing more volatility and maybe more of a flat line on the actual growth. If you've been in investments that have made a lot of money, it's not a bad thing to take some profits and protect that. I'd certainly say it's a bit premature to have a ton of money in bonds with the interest rates going up. That will impact the bonds negatively.
And they say that short-term, long-term bonds are about the same returns now. So
That's true.
There's no sense in going one way or the other.
Yeah.
I mean, going too long because you might get caught.
For sure, too long is definitely a bit more risk right now. And I mean, bonds are not a guarantee either, so that you can't just say, okay, I'm going there, it's safe. It's safer, but it's not safe. One of the things you need to look at, though, when the markets are volatile is where are you investing, or are you just sitting on your hands? And one of the things that is a good example of what to do is this particular chart.
A little chart here,
Yeah, which
closer,
if you can see the green spikes, the green spikes represent when the most inflow of money happens. And when the most inflow of money happens is when the markets are going really crazy, when everybody and their brother is telling you that this is the time to invest and they've just got the best hot deal. When you see the drops, which are in red, those are the times when you're hearing all the bad news. Everybody thinks you're going, down the tubes. This is the next recession or depression or whatever negative thing that is out there with the folks that you may be speaking with. And that's the time you really want to put the extra cash in. But long term, best idea is to just have quality investments that are not as likely to go in that complete roller coaster ride. It's having a diverse portfolio, and that's one of the things that we strive to do is help you create a diverse portfolio and use the investment companies that provide those really good cross-section of core investments that are less subject to the whims of the markets and the so-called experts.
Over the years, there's been a lot of talk about when's the best time to invest. Some people say, okay, invest as you go along, so dollar cost averaging sort of thing. And other people say, if you got the money, now's the time to put it in. What's your feeling?
Well, market timing is usually a fool's game. And so when you've got the money is probably the best time to invest. The tendency is if you sit the money in your bank account, it tends to disappear for something that you don't even remember what you spent it on. The dollar cost averaging works well because it's a forced savings. It's a way to consistently invest, and so whether the markets are up or down, you're still going to be investing, so you're going to benefit from that. So I wouldn't say there's a one size fits all, but certainly when the markets are really hot and everybody and their dog is investing in gold, sometimes that's the worst place to go.
Well, we don't want to, summertime, we don't want to keep people too long in front of their computers or tablets or phones watching this. So it's either a chance to get out in the sun or go dancing in the rain, whatever the situation is. And don't forget, rain or shine, August the 16th is our annual barbecue at our office at 1546 Bellevue. Anything else we should say before it's time to leave?
Oh, have fun in the sun.
Goodbye for now.